All right, well, thank you all for coming. The title of this talk is a little different from what has been advertised because I think I got my actual title to them a little bit late, but what I will be talking about is how the narrative about the financial crisis produced a very important piece of legislation called the Dodd-Frank Act. Now, it fits largely within this general question of the government's activities when you have a recession. And in fact, I will talk about this a little bit in the course of my discussion. But most of the material that I'll be talking about is going to come from a book that I have written, and I think the name of the book is up there. It's Hidden in Plain Sight. I'd like to get some questions afterwards, so if you want to take some notes about things that I'm not entirely clear on, I'd like that, and you can ask me questions after we're finished. Also, I want to be able to show you a list that CPAC wanted every speaker to provide, and that is a list of the things that I was talking about, what was significant about them, and what you as a member can do yourself to help along the ideas that have been presented in the lecture. So let me get started. Now, we all know that in 2008 there was a financial crisis, and it was caused by what was called a mortgage meltdown. What most of us don't know is how many of these bad mortgages there were, why they were made, and why the mortgage meltdown resulted in a financial crisis. Hi, Ken. The book I'm talking about today, which is called Hidden in Plain Sight, What Really Caused the World's Worst Financial Crisis and Why It Can Happen Again, is intended to provide answers to these questions. And as you will hear, this is a very important issue because of the effect it has had on our entire economy. The conventional narrative about the crisis is that the private sector, and I'm sure you've all heard this listening to the radio, watching television, reading newspapers, the Wall Street, and in particular, were not sufficiently regulated. And this is a simple and irresistibly attractive idea for the media. It involves greed by people who were already grossly overpaid, risk-taking with public funds, and bailing out of large financial institutions when ordinary homeowners were being evicted from their homes. In a recent Sunday New York Times article, for example, Gretchen Morgenson wrote this about efforts to reform the Dodd-Frank Act. It is remarkable to watch the same financial institutions that wrecked our nation's economy work to heighten risks in the system. And a few weeks ago, Treasury Secretary Jack Lew wrote in an op-ed, "It is hard to understand the efforts of some to undermine our ability to protect consumers and taxpayers from excessive risks taken by financial institutions." The facts, however, tell an entirely different story. On June 30, 2008, before the financial crisis, there were 55 million mortgages in the United States. Of these, 56%, 31 million mortgages, were subprime because borrowers had very low credit scores, or otherwise weak mortgages because, for example, the borrowers did not make any significant down payments. Of these mortgages, this 31 million mortgages, 76% were on the books of government agencies. And I think that tells you where the demand for these mortgages came from, because it was government agencies, including principally Fannie Mae and Freddie Mac, and I will describe who they are. It was Fannie Mae and Freddie Mac that made most of these purchases. Now here is what I hope is a slide that will show you where these mortgages were. Fannie Mae and Freddie Mac had about 16.5 million, FHA and other federal agencies, about 5 million. It all adds up to about 23.8, which is 76% of the 31 million bad mortgages that were on the that were in the market in 2008. Here's another fact, and one I think is also of interest. After Fannie and Freddie, these two large mortgage companies backed by the government, became insolvent, and they were taken over by their regulator, they reported that in 2008, their principal losses, 81% of their losses, came from subprime and other weak mortgages of the kind I was talking about. This tells us a lot. If the vast majority of the losses suffered by Fannie and Freddie came from subprime and other risky loans, it was mortgages of this kind that caused the financial crisis. And if 76% of these loans were on the books of government agencies, it follows that the government was responsible for the vast majority of the mortgages that caused the mortgage meltdown. Who then wrecked our economy, as Gretchen Morgenson said, or took excessive risks, as Secretary Lew said? Now, this is not a defense of the banks or the private sector generally. It is simply a case of trying to get the truth about the financial crisis out to the American people. Nor is it partisan. HUD, that is the Department of Housing and Urban Development, in both the George W. Bush administration and in the prior Clinton administration, implemented the same destructive policies. So we're not talking about Republicans or Democrats. We're saying bad policies were adopted by two kinds of administrations, Republican and Democrat, and caused the financial story. So what I'm trying to do is make the American people fully aware of what happened in the financial crisis, not the story that the media wants them to hear or what the government likes, but what the facts actually tell us. Still, there was an effort by the left to suppress this book. It was published on January 13 of this year, and by January 15, there were almost 50 one-star reviews of the book on Amazon. Now, if you know Amazon, you know that a one-star review is the lowest level you can possibly get, and it was really saying to people, don't buy this book, it's a waste of money. But the people who posted those reviews didn't leave it at that. They also said I was a liar or I was a sociopath. I mean, to me, this was an expression of a Stalinist impulse from the left, an effort to prevent people from getting information that the left does not want them to know. But it also backfired. By 2 weeks later, enough people had read the book so that there were actually a number of 5-star reviews on Amazon, and today there are more 5-star reviews than those original 1-star reviews, and if you go to Amazon, you can see for yourself. But while you're there, please buy the book and read it yourself and write your own review. Now, why is it important for all these facts to be known? I see several reasons. First, the false narrative was responsible for the enactment of the Dodd-Frank Act, and this is the issue that I'd like all of you to understand. This is why I wanted to talk to CPAC, because there is a tremendous relationship, an important relationship between the facts as they are understood by the American people and what Congress actually does. The false narrative, the idea that the private sector, and particularly the banks, were responsible for the financial crisis, was responsible for the enactment of the Dodd-Frank Act, which is easily the most restrictive law since the New Deal, and in turn has slowed the growth of our economy. Although unemployment has recently fallen, we are still in the midst of the slowest recovery since the mid-1960s. And that's because instead of focusing on economic growth, we made the financial sector the whipping boy for the crisis. We focused on punishing financial firms rather than trying to find out why we had a financial crisis. For this reason, I've often written, and I say in the book, that the Dodd-Frank Act is illegitimate. It's based on a false narrative, and was enacted without any serious investigation of the causes of the crisis. Now, there are a lot of Republicans and conservative members in Congress who would like to repeal or substantially modify the Dodd-Frank Act. But as shown by the very favorable media reaction to Elizabeth Warren's effort to criticize and beat back some modest changes in the Dodd-Frank Act, it will be difficult, if not impossible, to reform Dodd-Frank until the American people understand that the private sector was not the cause of the financial crisis. So I wrote the book not just to set the record straight about the financial crisis, but also to provide a foundation for repeal or reform of the Dodd-Frank Act. Second, if we have the wrong idea about what caused the crisis, we are likely to make the same mistakes again, and that's why the subtitle of the book is What Caused the World's Worst Financial Crisis and Why It Could Happen Again. This is already happening. A few weeks ago, the President proposed through HUD to reduce the premium for FHA loans. FHA makes very risky loans. In order to compensate themselves for this risk, they should have a good, solid, strong insurance premium to protect the taxpayers and to make sure that only people who are able to sustain a mortgage actually get mortgages. Lowering the premium will both increase FHA's losses and the number of subprime loans that FHA will ultimately insure. That's exactly how the government agencies came to own 76% of all of these very weak mortgages in 2008, just before the crisis. And that's why taxpayers had to bail out Fannie and Freddie in 2008 and FHA in 2013. If the American people and their representatives had understood that, there would have been an outcry when the President proposed to lower the FHA premium. If the President and his political advisors had understood that there would be an outcry, then they might not have done it. It's because the American people do not understand how government policies caused the financial crisis that the same thing is happening again. Then, third, when the cycle turns and we head into recession, who suffers the most? Clearly, it's the family that will be evicted. And those families turn out very often to be those the government helped. In 2010, Barney Frank, whose name you've probably heard, he was one of the principal sponsors of the policies that caused this financial crisis, said this. In 2000, he said, "It was a great mistake to push lower-income people into housing they couldn't afford and really couldn't handle it once they had it." So, to his credit, he finally understood that the policies that he had been promoting did not help the very people he was trying to help. Finally, when the government takes losses on defaulted mortgages, the taxpayers are not the only ones who suffer. Every mortgage that fails and every eviction that occurs drives down the value of every house in the neighborhood. In other words, all Americans, at least all homeowners, suffer when the government increases the likelihood of defaults by reducing the quality of the underwriting standards that we are using to make mortgages. Well then, how did these government policies actually cause the crisis? Let's begin at the beginning. Fannie Mae and Freddie Mac, and I've mentioned them now a couple of times, these are two giant mortgage companies backed by the government. They do not make loans themselves. They buy loans from banks and other originators. They then hold them in portfolio, or they securitize them and sell the securities backed by these loans. Before 1992, Fannie and Freddie would buy only prime mortgages. These typically required a 10% down payment, a low debt-to-income ratio, and a solid credit history. Because of Fannie and Freddie's insistence on prime loans, the market before 1992, and I'll explain why 1992 is significant, the market before 1992 was very stable, with default rates below 1%. Yet even during this period of prime underwriting standards, the home ownership rate was still 64%, exactly where it is today after all the evictions that occurred in the financial crisis. In 1992, however, Congress adopted something called the Affordable Housing Goals in order to increase mortgage credit for low-income borrowers. The goals imposed quotas on Fannie and Freddie when they bought mortgages from banks and other originators. At first, these quotas were modest. They required that Fannie and Freddie bought mortgages. When they bought mortgages, 30% had to be made to borrowers who were at or below the median income in the places where they lived. Now, this was not in itself a tough standard, but HUD was given the authority to increase the goals, and over time it did. So by the year 2000, 50% of all mortgages that Fannie and Freddie bought had to be made to people who are at or below the median income. These are the standards. You can look at them. You can see from which they start in 1996 and they go out to 2008, and you can see the percentages that were required for each of the goals and the what we'll call the sub-goals having to do with much lower income people and underserved goals for people who are minorities. You can see how they increased over time. By the year 2008, as you can see, 56% of all mortgages that Fannie and Freddie bought had to be made to people who were at or below the median income. In other words, they had to buy more mortgages from people below the median income than people who were above the median income. When more than half of the mortgages they were required to buy had to have been made to borrowers below median income, it was impossible to find the traditional prime mortgages that Fannie and Freddie always bought. They had to reduce their underwriting standards in order to meet the government's quotas. By 1995, they were accepting loans with 3% down payments, and by the year 2000, they were accepting loans with no down payments at all. That's how, in 2008, 76% of the subprime and other risky loans in the U.S. financial system ended up on the books of government agencies. But that's not all. The huge influx of new buyers, helped by government-backed leverage, built an enormous housing price bubble. And this is what it looked like. These are figures from Robert Shiller, who's a professor at Yale and probably the best student of this subject. And you can see that between about 1997 and 2007, there was a gigantic housing bubble. These are real numbers, that is, are adjusted for inflation. But you can see an enormous housing bubble that occurred during this period. When housing bubbles grow, defaults decline because the home is worth more than when it was originally purchased, and people who can't meet their mortgage obligations are then able to refinance the mortgage. So with few defaults, the market looks pretty safe. And many commentators believed that the risks of subprime loans were, for that reason, very low. Moreover, Fannie and Freddie did not disclose how many subprime loans and other risky loans they made. They said in SEC filings that their exposure was either minimal or less than 1%. They were not telling the truth here, and their managers have since been sued by the SEC for failure to disclose accurately the kinds of risks that they were taking. Now, the failure of Fannie and Freddie to disclose how many subprime mortgages and risky mortgages they took misled everyone: market analysts, regulators, risk managers at corporations, and investors about the riskiness of the market in 2008. And all this accounts, at least in part, for the growth of the private sector's involvement at all with these subprime loans. With 2020 hindsight, after the financial crisis, it's easy to say that the private sector was taking excessive risks. And if the government had 76% of the mortgages, then of course the private sector had the remaining 24%. Why did they even buy that 24%? And I think the reason is that there was so little information about the riskiness in the market that they actually thought, with very few defaults occurring, that this was not a very risky thing to do. Okay, there was one other factor, however, that is very important. You can all understand why low-quality mortgages would have this effect, but how did they produce a financial crisis? Most of the mortgages held by the banks and others were held in the form of mortgage-backed securities. Under accounting rules, these securities had to be marked to market, even if the underlying mortgages were still paying principal and interest as they were supposed to. When the bubble started to deflate in 2007, investors fled the market for these securities. Let me show you what this looked like. 2007, in the second quarter, you had a pretty strong market. See the bar. By the end of the fourth quarter of 2008, there was no market at all. In effect, without a market, the value of securities plummeted, at least in mark-to-market terms. And with with that, the capital levels of banks and other financial institutions also plummeted, because if you reduce the value of assets, it reduces the capital level of the institution. You look risky, you look perhaps even insolvent. Inevitably, these firms looked unstable. Now, the SEC could have suspended the mark-to-market rules. They could have said, hey, mark-to-market rules assume there's a market. But in fact, the SEC didn't do that. They, well, you might say they didn't have the internal fortitude to argue with the accounting profession, but in any event, they didn't do it. The turmoil in the market continued for 6 months until about March of 2009. There are some seats right up here if you'd like to come up here. Otherwise, we can always say it's standing room only. In March of 2009, they finally, something called the Financial Accounting Standards Board, finally, under pressure from Congress, reduced the accounting rules for mark-to-market accounting, eliminated them largely or suspended them substantially, and that's when the stock market began to recover. At that point, when those changes were made, the Dow Jones Industrial Average was 6,600. It's now 18,000. So we can see the difference that came from simply a major accounting change, and the effect that, at least on market psychology, that was the very accounting and the weakness that it showed for financial institutions had on how people thought about whether we were having a financial crisis. Now, why then did all of this turn into a financial crisis? Why did reductions in the capital and the financial status of all of these financial institutions cause a crisis? And that is also covered in the book. And I think this is a classic story of moral hazard. Investors, creditors, and managements relying on what they thought was a government policy. Moral hazard, if I can define it for you, is simply the idea that a person who is taking a risk has that risk reduced by something the government or even an insurance company might be doing. For example, insurers claim that if insurance covers people as drivers, then people will take more risks than they would ordinarily take, because they are reasonably sure that if they have an accident, the insurance company will cover their losses. That's called moral hazard. And moral hazard was increased by the government in one important respect. There are a couple of seats up here if you want to come up. In March 2009, the government rescued a firm called Bear Stearns. This was an investment bank, not a commercial bank, not one that was insured by the government, but it was rescued nevertheless by the government. the Federal Reserve provided $29 billion in support to allow J.P. Morgan Chase, one of the big New York investment banks, commercial banks on Wall Street, to buy Bear Stearns, $29 billion of support. At that point, market participants thought that the government had established a policy, a particular policy about what would happen in the future. They thought, I think reasonably, that the government was going to rescue all large financial institutions. And that changed everything. Managers no longer thought that they had to raise new equity in order to reassure their creditors that the firm was solid. They figured, not crazily, that if the government was going to rescue all the creditors, as they did in the case of Bear Stearns, well, then there was no reason for the creditors to run from a large firm that was going to fail, because the government would come in and bail them all out. So largely, financial institutions stopped raising new equity. In addition, the managers of many other firms that were weak already decided, for the same reasons, that they didn't have to sell out to other buyers, strategic investors or stronger firms that wanted to be buyers, because they figured they could drive a much harder bargain for their shareholders if they held out against these offers to purchase. Again, because they thought the creditors were going to be protected by the government. And finally, creditors of these companies felt that they didn't really have to sell or take any losses on any of their assets, any of the debt that they were holding, because the government would bail them out ultimately. And if that didn't happen, they were going to suffer some major losses. And that is exactly what happened. In September of 2008, the government completely reversed its policy. Lehman Brothers, even a bigger firm than Bear Stearns, was allowed to fail. That created the chaos that we saw in September of 2008, because most people in the market were unsure about what the future would hold. The government's policy, which they thought they understood, had now been completely reversed, and they were in a world in which there were a lot of weak-looking financial institutions, and they weren't sure at all how this would evolve. So that caused the financial crisis in this way, and that is that before, financial institutions were able to deal with one another, make loans to one another. That's how the financial system works. But now it became clear that in this panicky market, that if you didn't have the cash to meet any withdrawal from one of your customers, rumors might start that you were unable to meet cash obligations. And if a rumor like that started, then everyone would line up and pull their cash out of your firm. So banks, which had always lent to one another overnight, this is the way the banking system always worked. When one bank was short of cash, it could borrow from another bank at a very low rate. This is the way the banking system operated. Suddenly, at that point, the banks took the position that they would not lend to other banks even overnight. And that is something that market specialists had never seen before. And that's what, more than anything else, frightened them and turned this into the enormous financial crisis that it was. Ironically, that failure to rescue Lehman Brothers showed that it had been a huge mistake to rescue Bear Stearns. The reason a large financial institution like Bear Stearns was rescued was fear that there were interconnections between these large institutions, so that if one failed, it would drag down many others. However, Lehman Brothers proved that this was not true, that in fact a large financial institution could fail and it did not drag down anyone else. And that is one of the experiments that shows what the falsity of the proposition that interconnections among financial institutions were important. Now, the upshot of that is that we didn't need any regulation of very large financial institutions, because the failure of one of these did not necessarily mean that other financial institutions would be dragged down. But unfortunately, that isn't what the Dodd-Frank Act requires. The Dodd-Frank Act is based on the idea that these interconnections between large financial institutions are the major threat to the financial system. This is false, it's wrong. But because of that, much of the regulation that was introduced by the Dodd-Frank Act actually has the effect of restraining what the financial system can do, the credit that it can make available to the market in general, and that restraint has been the cause of the very weak recovery that this country has had since the financial crisis in 2008. This has been the weakest recovery since the middle of the 1960s, and I predict that unless we do something about the Dodd-Frank Act, this country will never recover the level of economic growth that it had in the Reagan period, in the Bush period, and even during the Clinton period, because the financial system has been so suppressed by all of this new regulation. So, if firms had not been frightened into a position where they would not lend to one another, if Bear Stearns had not actually been rescued, what would have happened? Seems to me the result would have been that many firms would have sought more equity, more stock equity, which would have protected their creditors. By the time we got to September of 2008, 6 months after Bear Stearns had presumably been allowed to fail, we would have had a much stronger financial system with many, many more firms having much more equity than they had in the 2008 that we actually had in the period when Lehman failed. As a result of that, even if Lehman had failed, and that would have been unlikely because Lehman would have raised the money too, we wouldn't have had a crash in 2008, and we wouldn't have had a financial crisis. So this is the story that the book tells. And I think it's important for everyone to understand that it is an alternative to the narrative that has carried the day up to now, which is that the government protected us against a much greater crisis that had been caused by the private sector, insufficient regulation of the private sector, risk-taking by the private sector and the banks. I think it's important that people understand this, and I'm doing as much as I can to make sure that the story that the book tells actually gets disseminated to the American people. So I hope now that I can answer some questions if you have some. Thank you.
Yeah,
go ahead.
First, a compliment. There was, your book is called Hidden in Plain Sight, and prior to the financial collapse in 2008, there was a local alliance in Washington to what Fannie Mae and Freddie Mac were doing, and it was reinforced by an aggressive lobbying operation by Fannie and Freddie, and only a handful of people had the guts to stand up to that, and you were one of them, so thank you for that.
Thank you.
So my question has to do with the law that was passed after Fannie and Freddie was revealed, the Housing and Economic Recovery Act. Curious to know your thoughts on that, especially in light of, I think, what Raka Ramrajan notes is this sort of strange impulse in among public policy people to encourage average Americans to leverage up, right? That economic inequality is growing, and yet budgetary constraints are very severe, and this is it's an off-budget way to subsidize people. And I'm very concerned about history repeating itself, and I don't have a lot of understanding of the line in the future?
It could keep these GSEs in line if it's properly used, but it won't be, as we can see right now, because it is in the nature of government to use things like underwriting standards, reducing underwriting standards in order to make it easier for people to buy homes. And you can imagine how this would help any government that is in office at a given time. If you reduce the underwriting standards, more people buy homes, the realtors are helped, the home builders are helped, the people who manufacture furniture and rugs and the gardeners, everyone is helped by more home ownership, at least more turnover in homes and more buying of homes. This costs the government nothing. It's not a budgetary item. The government is forcing things to happen in the economy that are helpful to the people in power, not helpful to the American people per se, actually turn out frequently to be costly to the taxpayers and to homeowners, but it does help the government. So, yes, the new regulations are there. They have some possibility of helping. If we have the right president, the right administration, yes, it could control Fannie Mae and Freddie Mac. But the danger is that the government is actually involved in housing finance right now. If we keep it involved in any way, the same thing is going to happen in the future. So the solution is for the government to be removed entirely from housing finance. Gradually, we can work Fannie Mae and Freddie Mac out of this system, and there are ways I propose to do that. But the important thing is not just Fannie Mae and Freddie Mac, which are only one way the government is doing this, but the government's activities themselves. Good question, though. Yes,
Peter, when the Freddie and Fannie bought the mortgages from the banks, so the banks were under quota to write these mortgages. So Freddie and Fannie buy them and liquefy the banks again to do more. My question is, if Freddie and Fannie weren't there to do that, to enable the banks to go out and bankroll more, because they had to have the cash. Otherwise, they're sitting with the mortgages. Doesn't that say that, doesn't it show that the government basically was, you know, they forced lending on the banks, and then effectively they used this as a means, a scheme to spend. It was government spending.
No. I don't think you should look at it that way. It wasn't, because the government never supported Fannie Mae and Freddie Mac.
Pardon?
Government did not support Fannie Mae and Freddie Mac. The government has bailed them out. They backed them. Everyone understands that they were backed, but they were borrowing in the private market to do what they were doing.
They borrowed from the private market.
They borrowed in the private market. That's why there was never any government, actual government budgetary funds involved in this. But the important point here is that we don't need Fannie and Freddie to do what they were doing, which is a very useful service, to buy mortgages from banks and provide them with more liquidity to make more mortgages does help the mortgage system. But it can be done entirely by the private sector. The government does not have to be involved. And we had a very robust private securitization system, that's what we're talking about here, a private securitization system before the financial crisis, and one that produced very good mortgages for a very long time until the government got involved through the affordable housing requirements in requiring Fannie Mae and Freddie Mac to reduce their mortgages. Remember, I told you that before 1992, Fannie and Freddie only made prime loans. And they only made prime loans because they were profit-making organizations. Now, yes, they were backed by the government, so they made more profits than they should have. They didn't have much competition, but they were careful not to buy mortgages that were low quality because those are bad investments. I think we have a little time for maybe one more question. Yes?
Can you kind of talk about, I mean, I could ask you some questions, but could you kind of talk about how Dodd-Frank is kind of plays into all this, and why it's, as a student, why it's easy for me to go to law school and get a $150,000 loan, but if I had a $60,000 a year job, it'd be tough for me to get a mortgage right now?
Well, there are so many reasons why it is very hard to get a mortgage. If that's your question, why is it hard to get a mortgage right now?
Okay, well, does Dodd-Frank kind of play into that?
It does in a way. The Dodd-Frank Act, this is so complicated, but let me just say this, that the Dodd-Frank Act provided a mechanism for creating a lot of authority in something called the Consumer Financial Protection Bureau. The Consumer Financial Protection Bureau, responding to a lot of pressure from the left, wrote a rule that says that if you make a loan, a mortgage loan, to someone who ultimately cannot afford the mortgage, you, the lender, are responsible for that. And the person who received the mortgage, the home buyer with the mortgage, could cancel the mortgage. In other words, own the home free and clear, which would be a terrible penalty for the lender, of course. Now, with a loan like that, many people in the mortgage business are afraid to make loans to people who might be unable to meet those mortgage obligations. So the loans that are being made today are either being made by the government through Fannie Mae and Freddie Mac and FHA, where those rules don't apply, or they are being made to people who have very solid credit ratings and very big down payments. So it's hard for people to get mortgages today. And in fact, Fannie Mae and Freddie Mac have been told by their regulator just a few weeks ago, we don't like the fact that you are putting in, you are accepting mortgages with 5% down payments, because most banks had moved up their down payments to about 5% to kind of protect themselves against the possibility of this, of getting sued by the mortgage, by the homeowner. So Fannie Mae and Freddie Mac were told, we want you to start insisting on 3% down payments. And well, why do they do that? It's exactly what I said before. They do that because they want more home buying to occur, more growth in the economy through the use of the home buying mechanism. I hope that answers your question, but it is certainly one of the reasons why it is so difficult today for people, ordinary people, to get mortgages. The legal requirements, the regulatory requirements have so frightened mortgage lenders that many banks have just gone out of the business entirely, and those that have not have been very, very careful about the loans that they are making. I have one obligation to CPAC here that I want to try to meet, and that is they asked me to be able to show you sort of a summary of what I was saying. Let's see if I can do this. This requires some skill that I probably don't have, but let's see. This is a summary, and the things that you could do as individuals. There we are. So, let's go to this one first. This is really basically the real title that I wanted to have for my speech. Didn't get it in time. But why a false narrative about the 2008 financial crisis led to the Dodd-Frank Act. Okay, now the question is, what have we learned? Now, I'll read these to you because it may not be easy to read this from the back of the room. The narrative about a policy issue drives the policy decision by Congress and the President. The false narrative about the financial crisis that it was caused by the failure of the private sector produced the Dodd-Frank Act. The Dodd-Frank Act caused and will continue to cause slow growth in the U.S. economy. Because Dodd-Frank was deliberately focused on the wrong target, it is illegitimate. Dodd-Frank has also allowed the government to restart the same policies that caused the crisis, the reduction in underwriting standards. To repeal or reform the Dodd-Frank Act will require educating the American people and Congress about what really caused the financial crisis. More information. You can get more information in my book. Let me see if I can show you a copy of the book. This book, it's actually, there's a signing, there will be a book signing downstairs in exhibit area D and E. at 5:30. If you'd like to get a copy of the book, and I will sign it for you, please come down and do that. Most of the information you need is in that book, but there's other really good work by conservatives. Mark Calabria at Cato has written some excellent stuff. So has Hester Pierce from Mercatus, and Norbert Michel of the Heritage Foundation. Other sources are the editorial pages of the Wall Street Journal, which is very solid on this issue, and the Washington Times, National Review, the Weekly Standard, Forbes, Investors Business Daily, and Barron's. All of those institutions regularly publish things that follow the same idea, but unfortunately they are completely overwhelmed in terms of the American public by NPR, ABC, CBS, NBC, and many, many other traditional mainstream media that constantly talk about the fact that the financial crisis was caused by insufficient regulation of the banks. So, I hope you've learned something from this process, and I hope that some of you will actually go out and buy the book. And I'd love to sign one for you if you go down to the exhibit area. Thank you all for attending.